and that whatever reset to come, whatever revaluation to come, whatever political mechanizations to come, from stablecoin to Doge to USA, whatever happens, we do know this. East and West, Brics and the IMF, West and East, are looking more of gold, looking more at gold in particular, as really the new reserve strategic asset. This is not an ordinary bull market. This is not an ordinary asset. This is a monetary metal, a precious metal. It's not even an ordinary commodity. It is not a surprise to see gold going back up again. It will not be a surprise when it passes 4,800 or 5,000 or 6,000, only because this is not a bull market in precious metals. It is a bear market in paper money.
The bullish momentum in the precious metals market continues, fueled by strong institutional demand and global debt concerns. Central banks, led by buyers in Poland, China, and others, have continued their structural accumulation, purchasing 220 tons in Q3 and are projected by analysts to keep buying strongly into 2026. This sustained demand, coupled with growing ETF inflows, has led to raised price forecasts, with Deutsche Bank now projecting an average gold price of $4,450 per ounce in 2026. Gold is increasingly viewed as a crucial hedge against the systemic problem of massive, unsustainable global debt, a problem central banks are addressing by monetizing debt and debasing paper currency. Matthew Piepenburg, a partner at Matterhorn Asset Management AG with a background as a transactional attorney, former hedge fund manager, and author, provides this insightful analysis. Drawing on history and macroeconomics, he argues that the current rise in gold is not merely an ordinary bull market in a commodity, but rather a bear market in paper money. Piepenburg emphasizes that gold and silver are monetary metals and a better store of value to preserve wealth against debased paper currency and systemic financial risk. He highlights that East and West, including Brics and the IMF, are looking to gold as the new reserve strategic asset, viewing the yellow metal's ascent as a geopolitical and historical movement, not a simple market trade. Let's watch clips from Matthew Piepenburg's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Yeah, again, we've been talking about gold for years, and certainly in the last few months when you see all-time highs, how many we've had this year, over 45, and then if there's a little bit of a pullback in the precious metals prices, silver or gold, there's a big concern. Have we reached peak gold in 2025? And then when gold gets back up again, those headlines dissipate. And I understand that, headline concern. I think for most of your viewers at this point who have a high conviction in precious metals, price movements in a bull market like this didn't dissuade them from their longer-term play and longer-term view on why you need to own precious metals. And I want to answer the question fairly without just, again, as always, suggesting just my conviction or bias. I've said many times, this is not an ordinary bull market. This is not an ordinary asset. This is a monetary metal, a precious metal. It's not even an ordinary commodity. It's not even an ordinary metal. And if you understand the context and why you originally bought gold and silver, which I hope was not just for immediate price appreciation to get rich, but because you understood and understand a systemic problem in the financial and the monetary system, not only in the US, but globally. And we'll talk about that. And I certainly would like to talk about silver too more, because for a lot of investors, that's a more affordable way to understand this. But when Egon von Greyerz started our company decades ago, it was with a long-term vision of many things, including banking risk and political risk and currency risk. But, there was a reason he was buying gold at those levels, and there was a reason he was holding it outside of the banking system, and there was a reason he would rather save in gold and silver than in dollars or euros or francs, or at the time, whatever, it was even pre-euro. It was simply because of an understanding of history and math and markets that the banks were risky, and we'll talk about banking risk, that holding your precious metals and your store of value, which is a better store of value than any paper currency outside of that banking system, made sense in 1995 and 2003, and it makes sense in 2025. If you understand these core issues, whether you bought gold at 1,600 or 2,800, or whether you buy gold when it gets to 5,200, you'll still understand why you bought it. And I think the simple answer is you can't know the solution if you don't know the problem. And decades ago, Egon and many others, and myself later, understood the problem. And the problem, of course, as we've discussed in so many iterations, and we can bring out all the data, it's not just sensational, is we have a massive, unsustainable global debt crisis. It has been percolating pre and post-COVID. It's been percolating pre and post-2008. When you have a debt crisis, wherever your zip code is, whatever your central bank is, whether it's the ECB, the Bank of England, whether it's the Fed, central banks from Australia to DC will monetize that unsustainable debt with money created literally ex nihilo, out of nowhere, expanding credit, expanding the money supply, and debasing the currency. That's a very simplistic understanding of the problem, that currency will be debased over the long term. The inherent purchasing power of your paper currency, whatever currency that is, certainly the home of the world reserve currency is important, that whatever that currency is, it will lose its inherent purchasing power over time, as it has done, again, from ancient Rome to Philip II in Portugal in the 1500s, to the British Empire, the Dutch Empire, the US Empire. Again, doesn't mean the end of all of these empires. Emphatically, Rome is still there, DC is still there, London is still there, but the purchasing power of those currencies and of those hegemonies inevitably debases itself because of the addiction to easy money and the addiction to debt to stay in power, whatever power that is, whether it's democracy or not. You need to spend. When you no longer have a chaperone to that money or that currency, whether it's a denarius or a dollar, you whittle away at the precious metal aspect. You decouple it from the gold standard, which is literally in Article 1 of our Constitution, and then you can go into greater debt, and that you can debase your currency. So again, simplistic historical lesson, but if you understand precious metals as a store of value, not a NVIDIA stock, not Anthropic, not a tech trade, not Tesla, whatever other asset that has made you rich or poor in the last 20 years, depending on your entries and exits, if you understand gold and silver as a better store of value to preserve your wealth against debased paper money, if gold goes down 10% in a 2-week period in these recent all-time highs, that doesn't bother you at all, because if you understand the problem, you have the conviction that this store of value, this silver or this gold that I own, is only going to go up further in a secular manner, not a straight line. It's only going to go up further in a secular manner because there is no immediate solution to the problem of debt. Again, we've talked about debt in 80 different ways, but it's nothing new throughout history. Sometimes history, again, is harder to see when you're in it. But no, as always with me, it's a long answer to a short question, but no, it is not a surprise to see gold going back up again. It will not be a surprise when it passes 4,800 or 5,000 or 6,000, only because this is not a bull market in precious metals. It is a bear market in paper money. You either believe that or you don't. You either accept that or you don't. We can spend a lot of time, and we have spent a lot of hours over the years talking about this. That's a personal choice. You should take your own informed judgment on that, but I think the evidence, which we can get into too, is fairly obvious that the world is catching on after decades of overextending debt levels to such a degree. It could be done for a while, but it's gone to that tipping point. It's like boiling water. It gets very hot for many, many minutes, and then at some point, it starts to boil. What we've seen since November of 24 and all of 25 is that boiling point has been reached. The water is now boiling. The awareness of the weakness of paper money in general, and the world reserve currency in particular, is now obvious, from the petrodollar to de-dollarization to the BIS to Morgan Stanley. The world is seeing this now, and I think retail investors, sadly, are the last to figure this out, because for decades they've been told by their private wealth managers or their online advisors or the RIA industrial complex that gold was just some pawn shop asset, or precious metals were passé analog pet rocks, despite the fact that gold has outperformed in total return the S&P for a quarter of a century. Now, that once intentionally misunderstood and ignored asset is making the headlines. Retail investors are starting to catch on that there's more to life than tech stocks or the S&P. And they're starting to ask why gold is rising. And if they take the time to really look, without, you don't have to go into thousands of history books, but if they take the time to get an objective opinion on what is currency debasement in the backdrop of a debt setting like this, it really isn't that hard to see. It doesn't mean that you can't look at Bitcoin or cryptos as other anti-fiat solutions. That's another rabbit hole. I'm here to talk about precious metals because that's what I've chosen. That's my bias. That's our conviction. We definitely want to hold this asset, as we've warned for decades, as Egon has seen for decades, outside of the banking system, which has many risks, and to hold it privately, the best gold you can get outside of that system, and to store your wealth in that, and to save, like central banks in the East are now doing, to save in a precious metal, which holds its value, and then spend in fiat as you need it. That explains why central banks now hold more gold than they do U.S. Treasuries. That sacred cow, that tier one asset of decades past, has now been replaced slowly but surely by physical gold. And we can look at the COMEX flows, and we can look at some of the wonky math, and we can look at the repo markets and the banking risks. But this isn't even a gold bug argument anymore. This is known everywhere. And I think it's sad that retail investors are still catching on. They're still less than 1% of their allocations to gold. They're still highly in the 60-40 or some version of the 80-20 stock bond portfolio. And they're trying to figure this out. And platforms like yours and opinions like mine are certainly worth looking at. They don't have to take it at face value on the first watch, so to speak. But I think most of your clients, certainly our listeners, they've heard this before. They know this. They have the conviction. So again, the price moves month to month, week to week, day to day, aren't really their main concern. And I'm not exaggerating. My partners and I and Egon, we don't really talk about the daily gold and silver price. We haven't talked about it for years because we just know with confidence that it will continue to move in a direction, again, never in a straight line, only because the situation in the global system, the global debt levels, is so empirically obvious now. And that whatever reset to come, whatever revaluation to come, whatever political mechanizations to come, from stablecoin to Doge to USA, whatever happens, we do know this: East and West, Brics and the IMF, West and East, are looking more of gold, looking more at gold in particular, as really the new reserve strategic asset. That is a geopolitical, historical move. It is not a market move with a chart that you just need Bollinger Bands to follow to buy and sell. Because if you really understand gold, you'll hold it as a store of value, and it will be worth more in 10 years than a $10 bill in your pocket, regardless of where the price goes.
The surge in gold and silver reflects a systemic flaw, a global, unsustainable debt crisis that central banks worldwide are addressing by consistently debasing their paper currencies. This is not a fleeting bull market in precious metals, but a prolonged bear market in fiat money, making physical gold an essential store of value and wealth preservation tool. As central banks in both the East and West increasingly position gold as a strategic reserve asset, investors are wise to follow this geopolitical and historical shift and hold gold outside the banking system for long-term protection. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.